All right, so let's move on and let's start with our first segment, which is Meet Your Fund Manager. Now, as the name goes, we talk to a fund manager from an AMC and help you understand the functionality of the fund and also the fund manager's strategy behind the fund. And today we are going to talk about Nippon India's power and infra fund, and for that we are joined by the fund manager, and he is Sanjay Doshi. Sanjay, welcome to the show. We are going to talk about your fund today, and Nippon India Power and Infra Fund is actually a thematic fund. It's a theme-based fund. But then to start off this interaction, I want to know what's the current trajectory or the story per se of this sector, and because we are talking about a variety of sectors under this umbrella of fund, let's start with power.
Yeah, so if we look at our thought about how we are looking at the space, we definitely see we are at a early phase of a new investment cycle. Whether we look at the power space or the infrastructure investment overall, and probably we are in the second year of a cycle, and this cycle is coming in after a gap of almost 8 to 10 years, where the space saw very lackluster growth. As far as the outlook is concerned, for the power space in particular, we see there is a transition which is happening from fossil fuel based more towards renewable, and for that you have significant investment which will be required on new generation as well as transmission and distribution side. We see a lot of efforts being made by the government, and at the same time, the mix will keep on improving towards renewable, but we will require base loads to fossil fuel for some period of time, maybe probably a few decades.
All right, let's talk about the infra theme under which there are various heads in the fund. Now, looking at the 2024 elections around the corner, and now even though the economic situation looks like picking steam, now what do you think this momentum is likely to continue?
Sure. So when we look at the current phase, as I mentioned earlier, that it's been after a good gap of 8 to 10 years that we are seeing growth coming back. And just to give some background, we believe this is the result of many factors which have turned favorable for the space. First and foremost, we see the government economic reforms and the government investment or infrastructure through the NIP and Gati Shakti program has played a very vital role in reviving the sector. We have seen government also give a lot of initiatives for the private sector revival through tax credits, corporate tax cuts, and new favorable tax rate for new manufacturing facilities, and now the PLI schemes. Second, what we have seen is as the economy rebounded from the COVID pandemic, we saw utilization levels improve across various industries like pharmaceuticals, chemicals, autos, cement, metals, oil and gas. And we have seen the profitability and cash flow for these industries improve meaningfully. These industries have also seen deleveraging on the balance sheet side over the last 3 to 5 years. And thus, they have enough firepower now to look at new investments. Third, we have seen the availability of credit has improved meaningfully as we saw resolution of non-performing assets in the banking system over the last 2 3 years. And there has been policy initiatives to attract long-term capital for the space. The real estate and the commodity cycle have also been very favorable for new investments. And lastly, we see the investments coming in for energy transition and digitalization or automation. And it's a combination of these which have seen a revival for the space in the last 18 to 24 months. Taking it forward, we believe this environment remains fairly constructive for robust growth in the space for the next 2 to 3 years, if not more. We see the government continuing on its trajectory of increased investment. This is because these infrastructure investment helps you to create long-term assets. It has huge employment generation potential, and it helps you to address a lot of inefficiencies which may be there in terms of higher logistic cost, energy cost, and have more sustainable development. On the private side, we see some of the large traditional industries like metals, oil and gas, real estate have now started to come back in investment phase. And we see commitments which are going to be there for PLI schemes, for energy transition and digitalization. So we are very hopeful of robust growth for the next 2, 3 years for the space.
All right. Now, Sanjay, I have a very layman question for you because our aim is also to educate investor towards what goes into a fund and a composition of the fund. So, talking about Nippon India Power and Infra Fund, what sectors are we looking at when we talk about this fund?
Yeah, sure. So when we look at the space, we had a power sector dedicated fund till 2018, and we improved the gambit to infrastructure, where power is roughly 20% odd. So when we look at the current composition of the fund, we have investment across power, cement, we have investment across engineering companies, real estate, defense and aerospace, oil and gas, telecom. So these are the areas that we invest in the space. We would not be investing into areas like pharmaceuticals or FMCG or IT or to that matter, even financial institutions or financial services. There would be limited involvement in this kind of a product.
Now, talking about power and infra, how much you think the international headwinds would impact this sector, or what is it that you can look at?
Sure. When we look at the space, it is largely domestic driven, which is a predominant area for us. Uh, as far as the global supply chain is concerned, that had some impact on execution. On the demand side, the exports would be relatively limited, around 15-20% max for some of the companies. If we see global recession or the trends of global recession staying on for much longer than what we anticipate, then there could be demand headwinds, which ultimately will have an impact on new capital investment. But that would be a relatively lower section as compared to the overall investment opportunity for this particular space. It's more domestic driven, and there we are very confident about robust growth for the next 2, 3 years.
Sure. All right. So on the domestic front, you see this fund doing very well. But then, tell me something from an investor's point of view. Can this fund be the first ever fund that an investment can have in their portfolio?
Yeah, it's a good question, and we should keep in mind that thematics have a relatively higher volatility as compared to the diversified funds. These are also driven by particular cycle of theirs. So one has to be very careful about it. It also depends on individual risk appetite, individual investors' risk appetite, and the current composition of their fund. So in that context, I would say that for a conservative kind of an investor, this should not be probably a first investment. But if you look at from a portfolio perspective, we think that thematics do find a place almost like 20-25% one can look at in the overall portfolio. And given where we are in the cycle for infrastructure investment and our thesis about positive outlook for the next few years, it definitely makes a good entry point for an investor. But it has to be mindful about the allocation being done and the individual investor risk appetite.
So you have a lot of sectors under this fund head. Now let's talk about your stock selection or your company selection when it comes to having a fund like this, which is very theme based and involves a lot of sectors in it.
Yeah, so again, a very good question for us. When we look at the opportunities within the infrastructure and power space, we would also look at areas that we believe will give us a lot of opportunity of higher growth from a 3, 5 year perspective. So we have identified a few themes or few subsegments where we believe the potential for growth is much higher. To name a few key among them would be energy transition, which would also include a part of the power investment. It would include areas like digitalization or Industry 4.0 or automation, where we have seen a significant benefit for companies during the pandemic and thereafter. Real estate is one area where we are positive. Defense and space and defense indigenization is a key theme, and railway capex and PLI-led investment. So these are the themes that we have identified where we believe we should be able to benefit from relatively higher growth opportunities. As far as stock selection within the fund is concerned, we are very particular to balance things out also. As such, the sector has relatively higher volatility. We don't want to add further to that volatility by having more commodity kind of businesses. So we'll be very mindful of the weights of commodity kind of businesses in the fund. At the same time, companies which are relatively weak on competitive positioning or they have higher financial leverage, we would be mindful of our weights in these kind of individual companies. So we would try to balance out the portfolio by having a good mix of large cap, mid cap, and small caps. We don't want to tilt it significantly towards small cap because that further increases the volatility. And at the same time, we would like to focus more on leaders or companies who have relatively competitive advantage in the themes that we have identified. So that is how we try to balance out and at the same time maximize on the opportunity which is available.
Sure. I want to talk about real estate over here. You think this has picked up after a long period of slowdown? How do you look at this sector in specific?
Yeah, I definitely believe so. Again, it's a very deep cyclical space. And what we have seen in the last 18 to 24 months, the inventory levels have been reducing in terms of ready inventory. So there has been good offtake. And now we're also seeing signs of price increases, which is happening in key metros and even tier two, tier three areas. Even commercial real estate has come up quite meaningfully after the after effects of pandemic. So we definitely see this area again being a deep cyclical, just at the beginning of a new cycle. And we have seen a lot of capital also being attracted on the commercial side and REIT side. And a lot of these players have been able to raise meaningful capital for further expansion. So we definitely see room of this cycle continuing for real estate.
So when we look at the sector of when we look at the sector allocation in your fund, you look very bullish on aerospace and defense. Now, what's the story behind it? What's the strategy? Could you elaborate?
Yeah, so when we look at defense as an opportunity, what we see is government has taken serious steps to improve indigenization. We saw how we are neighbors. We have to be able to manage our own security, not depending on foreign technologies. And we have seen many platforms being accepted by armed forces. Basically, it means that they are in global standards. And the initiatives taken on positive list, I would call it, rather than a negative list, which is a negative list from an import perspective, but a positive list from a domestic orientation perspective. That number has been increasing. So the opportunity available for Indian companies and the defense space has gone up meaningfully. So if you look at the overall defense budget, on the capital side, whatever spending used to happen, almost 60-70% would be dependent on foreign technologies. And now that is almost reversed. So almost 60-70% is now through domestic oriented companies. And that is how the pie has been meaningfully increased. And we see this trend continuing. There is also opportunity to export to friendly neighbors as these platforms mature. And not to forget that some of these platforms have very long life, more than few decades. And the opportunity to service spares and overhaul of these systems during the lifetime is sometimes meaningfully more than the original cost. So that is a kind of opportunity one can expect once you have your platforms accepted on a global standard.
But when we look at these sectors, what is the 5 year timeline of these sectors you've picked? You will obviously make changes, drop few sectors, or maybe increase allocations. But which are the one where you plan to hang on, the spaces that you want to stick to, and the time horizon for this could be 5 years or more than that?
Yeah, so from a medium term perspective, as I highlighted, certain themes would run even more than 5 years. Key among them would be energy transition. Basically, we are talking about reducing carbon footprint in this particular theme. And the investments here will run into decades. Obviously, it will be not that easy to identify winners in the current stage, but this theme has a definite long runway ahead. Similarly, the benefits of Industry 4.0 has just started to materialize, and that has significant benefit on improving efficiencies and having better utilization of your existing assets. And that meaningfully will improve going forward. Defense is one area, again, where we believe we have just started on our journey of local defense opportunities. And that will be another meaningful opportunity from a 3-5 year perspective. And lastly, railway capex is also an area where we believe a lot of groundwork has been done. We have seen an improvement in movement of goods or freight on the railway side versus other modes of transport. And we have seen the steps being taken on medium speed and high speed trains, and that will have a very long runway of growth opportunity. So these are the 4, 5 themes that we believe we can stick around for 4, 5 years kind of a time frame and relook at these opportunities as time goes by.
Now, when we look at the returns, now even though this is one fund, but then we have various sectors in it connected to power and infra. According to you, which is that sector that's been holding on to the returns or helping the fund perform better in this kind of volatile period?
Yeah, so if I look at the last 2 years kind of a time period, what benefited us a lot was an exposure to defense. We were among the early entrants, and the valuations were very, very favorable 2 years back. And that has played a very important role in our improvement in performance. Along with that, a few engineering companies, which are again beneficiaries of digitalization or energy transition and real estate. So these are the themes which have worked very well for us. Looking into the future, again, we have tried to identify a few themes, and we would like to leverage on companies where we believe they have the capabilities to scale up quite meaningfully. And if things go right, we hope to get the benefit of these plays over the next 3, 5 years.
Could you elaborate on the sectors that you are looking for in the future? Have you identified few?
Yeah, so as I mentioned earlier, 4, 5 themes that we believe can work very well are on energy transition, which is basically decarbonization or reducing the carbon footprint, moving towards renewable and reducing fossil fuels on both the power and application part of it. Similarly, railway capex, defense indigenization, and automation or Industry 4.0 are some of the key themes which we believe will do relatively better versus other areas.
Now, from an investor point of view question, a lot of times the kind of stocks or sectors we are talking about under power and infra also covered in a large cap or maybe a flexi cap or a multi cap. So, exactly how much of an exposure should an investor give to a particular theme based fund, and specifically talking about your fund?
Yeah, it is important to consider thematics and try to understand why these make sense for investors. You're right that within diversified portfolios also, you will have certain stocks or certain themes which are part of their funds. But normally, what we have observed is the share is relatively lower. Um, Most of these themes would probably be to the extent of 10 to 15% of diversified funds, where you have many other sectors which have much larger share. So, in that sense, the benefit that an individual investor may get from playing a thematic will be limited. What is also important to understand is where we are in a cycle for a particular theme. If I can give you some anecdotal example, the last big investment phase that the country saw was in a period of 2000 to 2003 to 2009 kind of a time frame. If you look at the BSE cap good returns in that period versus broader market, which is Nifty, it is meaningfully higher. It is almost like 70-75% higher in that period of 6 years or 7 years. So that is a kind of benefit an individual investor may get if you are able to ride the cycle and if you hold on for these investment from a 4, 5 year period so that you can maximize on the potential from the cycle. And as I said earlier, that we had a period of almost 10 years where the growth was relatively lackluster. A lot of cleaning had to happen. And now we have seen reforms and the positive environment of business sentiment kicking in. And we have seen the early phase of a new cycle. So if we are looking at a cycle of 4, 5 years, which normally is the period for any particular cycle, if not more, then we are definitely looking at another 3, 4 years of good growth. And therefore, an investor can maximize returns versus a diversified by taking a measured exposure based on their own risk appetite and the portfolio composition that they have.
All right, last question to you. Word of caution for the investors to invest in this fund or this particular sector?
Yeah, a few things. First of all, you need to appreciate the risk associated, which is relatively higher volatility of these funds. If you are in a right cycle, then probably the volatility level will be reduced. So that is one. Second is if the overall demand environment sees a very sharp deterioration, then we could have a scenario where people will relook at their investment commitments and there could be some delays. Similarly, if there are policy uncertainty or there is uncertainty about availability of finance at an appropriate rate, where it makes sense to make those investments, there could be some delays in decision making. We see some of this risk may materialize on a global, if you look at from a global point of view, but from a domestic side, we are relatively more comfortable and being more domestic cycle oriented themes, I think it still makes sense, but these are the areas which one need to be cautious when you're looking at thematic funds.
All right, Sanjay, thank you so much for being on the show and explaining not only your fund strategies but also about the sector where investors can invest depending on their diversification. With that, we'll take a short break, but then more on personal finance after this break.